Welcome to Wealth and Means. Advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode is about signals hiding in plain sight. YouTube obsessions no network would greenlight, movies without capes, stocks moving quietly on volume, and data that looks boring until it suddenly matters. We start with what you didn't see in the news, where culture, markets, and curiosity are compounding faster than hype. Then wake up ready, a thin holiday week with just enough global data to set the tone for 2026. After that, a knowledge bomb on what the S&P 500 really exposes you to. Humor me, from the behavioral economics lab known as roommates, the greater debate, where true wealth actually comes from, and we close with the invention of the personal computer.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. All right, let's talk about the stuff that technically isn't breaking news, but tells you a lot about where attention is drifting. What you didn't see in the news. Somewhere on YouTube this week, a creator named Anya Austin racked up more than 700,000 views asking a question no executive producer would ever greenlight. How many trees are there in Skyrim? Not metaphorical trees, literal trees, counted with stats, on-foot surveys, and even a charity wager tied to the result. The key fact here isn't the final number. It's that people will happily sit through a long, methodical, hyper-nerdy explainer if the curiosity hook is strong enough. The implication? There's a growing audience for deep-dive content that treats obsession as a feature, not a bug. This is the long essay video trend quietly expanding under the mainstream radar.
It's Wikipedia energy, but with cinematography.
Then there's Alpharad, who dropped Pokemon Too Many Types 2. It's modded Pokemon, rule-breaking mechanics, inside jokes stacked on inside jokes. Strong momentum, big engagement, but still very much subculture, not Marvel-level mass appeal. The key point, fandoms don't need to go mainstream to be commercially viable anymore. They just need to be intense, loyal, and algorithm-friendly. Now jump to Hollywood. Sony released the trailer for The Breadwinner, a mid-budget family comedy starring Nate Bargatze and Mandy Moore. It's not dominating the internet the way a superhero sequel would, but that's the story. Studios are testing whether theatrical comedy can still pull people off the couch without capes, explosions, or cinematic universes. If this movie overperforms expectations, it's a small but meaningful signal that normal movies might still have a lane. Search data also lit up around KJ Apa thanks to First Looks from Jimmy, a Jimmy Stewart biopic where Apa takes on one of the most recognizable voices in American film history. The conversation is circling around the accent, the nostalgia factor, and whether this is award season bait or just prestige cosplay. The implication? This one could snowball fast if early reviews validate the performance, or disappear just as quickly if they don't. Podcast land is having a quiet moment too. Smosh Reads Reddit Stories continues to gain traction by turning internet confessionals into interactive storytelling. Meanwhile, true crime newcomers like Deadly Mirage and Murder in the Moonlight are climbing top new shows lists without yet joining the true crime Mount Rushmore. Add Unicorn Girl, a fiction-forward narrative series popping up in subscriber charts, and you see the pattern. Audiences are experimenting. They're not abandoning the old staples, but they're sampling aggressively. On the market side, Hecla mining is quietly becoming a favorite silver and gold torque trade. The key fact is simple. When precious metals move, Hecla tends to move more. That leverage, combined with renewed interest in metals, pulled fresh attention this week, even without headline-grabbing news. And then there's the big, boring-looking list that actually matters. Infosys, Warner Bros. Discovery, Intel, Broadcom, Apple, Tesla, Comcast, AT&T, Pfizer. None of these were the single most traded stock of the day, but they all saw elevated volume in that 90 to 170 million share range. That's classic institutional behavior. Year-end rebalancing, sector rotations, quiet conviction trades. This is where positioning shifts show up before they become headlines.
It's the financial equivalent of watching traffic patterns instead of sirens.
Exactly. None of this stuff screams for attention, but together, it tells you where curiosity, capital, and culture are gently leaning next. Now let's wake up ready. All right, before we dive in, quick scene setting. We're in that weird stretch between Christmas and New Year's, where inboxes are quiet, liquidity is thin, and markets are basically running on vibes and coffee. Big earnings are off the board, calendars are light, which means when data does hit, it can punch above its weight. So this is your wake up ready. What to watch, why it matters, and where the landmines are hiding as we close out the year and step into 2026. Let's start overseas, because the week actually kicks off while most of the US is still in weekend mode. Late Saturday night US time, China drops year-to-date industrial profits. This is one of those numbers that doesn't trend on social media, but it absolutely matters if you care about global growth. The question here is simple. Are Chinese factories making money again, or still grinding through margin pressure? If profits are stabilizing, that's quietly constructive for energy, metals, and global industrials. If not, it reinforces the idea that China's recovery remains uneven, and that caps enthusiasm for commodities heading into Q1.
So this is less about China stocks specifically and more about the knock-on effects.
Exactly. This is a demand pulse check for the rest of the world. Monday is sneakily busy. We get a global tour before lunch and a US data cluster in the afternoon. India reports industrial production, watching whether one of the world's fastest-growing demand centers is still humming. Russia posts a manufacturing PMI, which gives a quick read on activity in a major energy exporter. Brazil releases inflation data that feeds straight into local rates and risk appetite, and France updates jobless figures, which help frame the Eurozone labor picture. Then back home, the US finally wakes up. Pending home sales tell us whether housing demand is thawing or still frozen under higher rates. The Dallas Fed Manufacturing Index gives a regional read that's especially relevant for Texas. Think energy, machinery, and real economy momentum. And then, energy traders get their usual late-day double feature: oil inventories and natural gas storage. In a holiday week, these numbers can move prices more than usual, simply because there's less volume to absorb surprises. The big question for Monday: are we closing the year with signs of steady demand, or do the cracks in housing and manufacturing widen just as liquidity thins out? Tuesday is about signals, not fireworks. South Africa runs a bond auction, worth watching for stress in funding costs tied to gold, platinum, and coal exposure. Brazil releases a few secondary inflation and trade updates, only market moving if they surprise. In the US, advanced trade and inventory data drops. This one feeds directly into GDP math. A big swing in imports, exports, or inventories can quietly rewrite Q4 growth expectations.
This is the kind of report that markets pretend not to care about until they suddenly do.
Right, it's boring until it isn't. The takeaway for Tuesday: is the US economy ending the year with healthy inventory rebuilding, or does it look more like demand is slowing under the hood? Wednesday is less about new information and more about conditions. Japan releases the Bank of Japan's Summary of Opinions, which traders parse for clues on future policy shifts. Any hint of tightening matters for the yen, global bond yields, and carry trades. Europe auctions short-term bills, giving a snapshot of funding conditions. Meanwhile, in the US, financial conditions indexes update, essentially compressing credit spreads, leverage, and funding stress into a single score. Markets close early, liquidity is thin. Moves in oil, gas, FX, or crypto can look dramatic, even if the underlying news is minor. Key question for New Year's Eve: are we ending 2025 with signs of stress or a relatively orderly handoff into the new year? Thursday, January 1st, New Year's Day. Markets are closed, no data, no earnings. But that doesn't mean nothing happens. Any price action you see will be driven by futures, FX, crypto, or overseas markets reacting to headlines, not scheduled releases. Think of this as the pause before the real kickoff. Friday is where everything snaps back into focus. This is the most important day of the entire window. We get the ISM Manufacturing PMI, a top-tier indicator for growth, earnings, and sentiment. Above 50 suggests expansion. Below 50 reinforces slowdown narratives. This one number can reset expectations for industrials, semis, commodities, and rates in a single morning. Construction spending follows, which matters for infrastructure, reshoring themes, and real economy capex. Housing price data adds another lens on affordability and consumer balance sheets. Globally, manufacturing PMIs roll in across the US, Europe, Japan, China, and emerging markets. This gives investors a synchronized snapshot of whether global factories are accelerating together or dragging each other down.
So Friday's really the first truth serum read of 2026.
That's exactly right. It's the market asking, are we stabilizing or just catching our breath? The big questions heading into the weekend. Does manufacturing confirm a trough or deeper contraction? Is construction holding up under higher for longer rates? And do global PMIs hint at synchronized growth or synchronized slowdown? That's Wake Up Ready, a quiet week on the surface, but with just enough data underneath to set the tone for how markets walk into 2026.
Knowledge bomb. Most people talk about the S&P 500 like it's one thing, a single blob called the market. But that's like calling a city a building. Under the hood, the S&P 500 is 500 companies spread across 11 very different sectors, each one a separate engine of the U.S. economy. And here's the key twist. How those companies are weighted inside the index completely changes what you're actually exposed to. Let's start with the cast of characters. Technology is the heavyweight champ. Apple, Microsoft, Nvidia, the companies that run the digital nervous system of the economy. They're massive, profitable, and dominant, which is why tech carries outsized influence in the index. Communication services is where attention lives. Google, Meta, Netflix, Disney, advertising, media, streaming, and the pipes that keep us all connected. Consumer discretionary is lifestyle spending. Amazon, Tesla, Nike, Home Depot. These stocks rise when people feel confident and tighten when wallets get cautious. Consumer staples are the opposite. Toothpaste, soda, groceries. Boring in the best way. They don't shoot the lights out, but they rarely disappear when things get ugly. Healthcare sits at the intersection of aging demographics, science, and regulation. Drug makers, insurers, medical devices. Long-term essential, short-term politically volatile. Financials are the plumbing of capitalism. Banks, insurers, payment networks, sensitive to rates, credit cycles, and regulation, but absolutely central. Industrials are the physical backbone. Planes, machinery, logistics, defense. When capital spending ramps up, they tend to hum. Energy is oil and gas, cyclical, geopolitical, volatile, but still fundamental to global growth. Materials supply the raw inputs. Mining, chemicals, construction materials. No growth story works without them. Utilities are steady, regulated, predictable, great for income, rarely for excitement. And real estate is property ownership at scale, often driven more by interest rates than by GDP. Now here's where the real knowledge bomb lands. Most investors own the market cap weighted S&P 500. That means the biggest companies get the biggest say. Apple, Microsoft, and Nvidia don't just participate, they steer the ship. Tech can be nearly a third of the entire index. When tech wins, the market looks unstoppable. When tech stumbles, everything suddenly feels broken, even if most companies are doing fine. A cap-weighted index is essentially a bet that today's giants stay on top. The equal weight version flips the logic. Every company, giant or mid-sized, gets the same vote. Apple counts no more than a regional bank or an industrial supplier. Sector exposure shifts dramatically. Tech shrinks. Industrials and consumer stocks matter more. The index starts to behave like the average U.S. company, not just the biggest ones. That means performance depends on market breadth, how many stocks are participating, rather than a handful of megacaps carrying everyone else. Historically, equal weight shines when leadership broadens, when lagging sectors catch up, when the economy lifts more boats. It struggles when returns are hyper-concentrated, like the recent years when a small group of tech giants did almost all the heavy lifting. So here's the takeaway. When you say, I own the S&P 500, that's not the end of the story. It's the beginning. Market cap weighting gives you a concentrated bet on today's winners. Equal weight gives you a more democratic snapshot of corporate America. Same 500 companies, very different risks, very different narratives. And that's why the S&P 500 sometimes behaves less like the whole economy and more like a tech stock wearing a trench coat.
Now it's time for some humor me moments from listeners. Listener Chaotic Chris from Chicago shares this gem. My 3 roommates and I had a group chat for splitting bills. Rent was easy. Venmo requests flew out like clockwork. But utilities? We'd get the bill, argue over who left the lights on, and then crickets. One month, I paid the whole electric bill myself because no one responded, only to find out later my roommate had accidentally used my share to buy takeout. Now we have a shared spreadsheet, but it's mostly just memes about how we're all secretly hoping someone else pays first. Sound familiar? We've all been in that roommate standoff where the utility bill becomes this mythical beast no one wants to slay, until the lights flicker and suddenly everyone's a financial expert. Shout out to Anxious Anna who emailed, living with 2 roommates, we rotated who collected rent each month. My turn? I sent polite reminders a week early. Their turns? Radio silence until the landlord's knocking. One time, we scrambled at midnight on the due date, pooling cash from couch cushions and forgotten wallets. Turns out one roommate forgot because they spent their share on concert tickets. We made it, but now we auto-schedule everything. Ah yes, the classic roommate rent dance, that awkward mix of trust, selective memory, and last-minute panic that turns grown adults into raccoons rummaging for spare change. And then there's Spreadsheet Sam, who wrote in to confess, I built a color-coded expense tracker with formulas, charts, even a tab called Fairness Index. No one used it. They just reacted with thumbs-up emojis and kept paying late, which is a perfect reminder that the problem was never the math, it was the humans.
Every roommate system eventually converges on the same economic model. One person becomes the central bank, one becomes the moral hazard, and everyone else claims they'll settle up next week.
So if you're out there right now, staring at a shared bill, refreshing Venmo like it's a slot machine, take comfort. You're not bad with money. You're just living in a live-action behavioral economics experiment. And yes, we want your stories. What's your wildest rent or bill-splitting saga? Send it in. We promise not to charge interest.
Welcome back to the greater debate. The debate that should happen, but almost never does, because it's the kind that empties a room faster than a bill at brunch. Someone storms out. Someone Googles off-grid cabins, and someone else quietly decides never to bring this up again. But here, armed with imagination, caffeine, and a suspicious number of unresolved assumptions, we make it happen anyway. The stage is simple. 2 lecterns, no slides, no safety nets, just a question that sounds polite enough to ask at dinner, but dangerous enough to rearrange a life. Where does true wealth actually come from? On one side stands Morgan Housel, calm, conversational, almost disarming. He doesn't talk about yachts or status, he talks about control, about mornings you own, about the ability to say no without panic. Money, he argues, isn't happiness, it's the removal of fear. It's the quiet accumulation that buys time autonomy, the most universally desired asset on earth. Without financial slack, every other pursuit becomes conditional. Relationships strain, health deteriorates, purpose gets postponed. Money doesn't make life meaningful, he says, but it makes meaning possible by removing the survival tax that quietly corrodes everything else. Across from him is Arthur Brooks, equally composed but armed with decades of data and a sharper warning. Yes, money matters up to a point. It reduces misery, it stabilizes life. But beyond basic comfort, its power fades fast. Happiness doesn't scale with income, it scales with connection, with health, with purpose, with love. Brooks points to the evidence that people adapt quickly to wealth, but never adapt to loneliness or meaninglessness. He's met billionaires who are miserable, and middle-income families who are deeply fulfilled. Money, he insists, is a tool, not the treasure. Confuse the two and you sacrifice the very things that make life rich. Housel fires back gently but firmly. It's easy, he says, to dismiss money once you have enough of it. Financial stress isn't a nuisance. It hijacks the mind, poisons relationships, and makes long-term thinking nearly impossible. You can't build joy while drowning. Money removes the water. And real wealth, he reminds us, isn't spending. It's saving. It's optionality. It's the compounding of quiet decisions that buy freedom long before a dollar is ever consumed. That freedom is what allows people to show up as better parents, partners, and humans. Brooks nods and counters. And yet he says people often trade their lives for money, then try to buy their lives back. They postpone love, postpone health, postpone joy. After I hit my number. Except the number moves and time doesn't. Money can buy time, yes, but it can't teach you what to do with it. When money becomes identity, even subtly, it crowds out the very things it was meant to support. Friction isn't the enemy. Meaninglessness is. Then comes the rare moment of honesty that raises the stakes. Housel concedes that blind accumulation without a stopping rule turns money into a psychological trap. Safety becomes scorekeeping. Winning turns into an endless game. Money opens the door, but it doesn't tell you which room to walk into. Brooks concedes that purpose is hard to pursue when your nervous system is on fire. Financial security creates the conditions for happiness, even if it isn't happiness itself. But mistaking the foundation for the house, he warns, leaves you living in the basement. Housel closes with a structural blow. Every non-monetary good we cherish becomes fragile without control over our time. Money doesn't guarantee fulfillment, but without it, fulfillment is easily destroyed. True wealth, he says, is freedom first. Everything else is built on top. Brooks answers just as cleanly. Freedom without direction is emptiness. The happiest lives aren't the freest. They're the most connected, the richest in love, the deepest in meaning, the healthiest in body and spirit. Money can support that life, but only if it knows its place. Make it the goal and it will quietly take everything else. And that's the tension we're left with. No villain, no clean winner, just an uncomfortable truth worth sitting with. You need money to live well. But you don't live well for money. And that is the greater debate.
And with that insight, let's invent again. If you want to understand why personal computing feels inevitable today, you have to go back to a moment when it absolutely wasn't. And you have to start with Steve Wozniak, not the mythic Silicon Valley archetype, but a shy, prank-loving engineer who believed almost stubbornly that elegant design could put real power into ordinary hands. Woz grew up in San Jose, in the shadow of defense contractors and circuit boards, the son of an engineer who taught him something radical for the time. Engineers didn't just solve problems, they changed how people lived. While others chased prestige or profit, Woz chased efficiency. He obsessed over how to do more with less, fewer chips, fewer parts, fewer dollars. That instinct would end up reshaping an entire industry. In the mid-1970s, computing was still a gated community. Machines lived in universities and corporations, guarded by budgets and specialists. Then Woz built the Apple I, a bare circuit board that looked unimpressive but quietly crossed a line. For the first time, a regular person could own a computer and plug it into a TV. It wasn't friendly, it wasn't pretty, but it was personal. The real breakthrough came with the Apple II. This is where Woz's philosophy became tangible. Color graphics when competitors were monochrome. Expansion slots that invited experimentation instead of locking users out. A disk controller so efficient it bordered on artistic minimalism. Basic built into ROM so anyone could start typing and creating within minutes. This wasn't just a machine, it was an invitation. That openness mattered. The Apple II didn't just sell computers, it created ecosystems. Hobbyists built add-ons, developers wrote software, and then VisiCalc arrived, quietly turning the Apple II into a business weapon. Overnight, spreadsheets justified computers on desks across America. Apple went from a garage experiment to a serious company, and competitors, including IBM, had to respond. What's striking, especially through a modern lens, is that this revolution wasn't driven by scale or capital at first. It was driven by taste. Woz didn't design for control. He designed for empowerment. That choice shaped everything that followed. From education labs packed with Apple IIs to generations of kids who learned to code because the machine encouraged curiosity instead of intimidation. After leaving Apple Computer Inc., Woz never stopped tinkering. Universal remotes, GPS hardware, enterprise storage, online education, even space debris tracking. The pattern stayed the same. Find a system that feels opaque or unfair, then make it more accessible. In recent years, that instinct has pushed him toward right-to-repair advocacy, skepticism about unchecked AI, and projects aimed at sustainability and transparency. That's where Wozniak's relevance in 2025 really sharpens. We're once again at a moment where technology is powerful but increasingly abstracted away from users. AI models we don't understand, devices we can't fix, platforms we don't control. Woz's legacy is a reminder that progress doesn't have to mean opacity. User-centric design isn't nostalgia, it's a competitive advantage, and increasingly, an ethical stance. The Apple II didn't just launch the PC era, it established a principle that still matters. The most transformative technologies aren't the ones that look impressive in labs or boardrooms. They're the ones that invite people in. And in a world racing toward ambient computing and autonomous systems, that may be Wozniak's most enduring lesson, that engineers still have the power and the responsibility to change everyday life for the better. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the range from nerdy internet obsessions and quiet market signals to global data, index mechanics, behavioral finance, and the question of what wealth really means in the first place. None of it screamed for attention. All of it tells you something about where curiosity, capital, and culture are leaning next. That's Wealth and Means.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious.
Stay kind.
And keep compounding.